This is Kenji Sinclair. Gold just held a support level that, if it breaks, changes everything. But here's the part nobody's saying out loud. The Federal Reserve is now permanently trapped. Not stuck for a quarter, not stuck for a cycle. Trapped, period. And that trap is the single biggest reason your cash is quietly losing a war you didn't know you were fighting. In the next 10 minutes, I'm breaking down 3 things. 1. Why America's debt spiral has boxed the Fed into a corner it can't cut or hike its way out of. 2. Why that trap is accelerating currency debasement and threatening the dollar's grip on global reserve status. And 3. Why physical gold and silver aren't just a hedge anymore. They're becoming the only rational shelter left. Stick around, because point 3 is the one that actually tells you what to do with this information, not just what to worry about. Let's get into it. Let's start with the number that should scare you more than any headline this year. The U.S. national debt just blew past levels that historically no advanced economy has ever walked back without a currency crisis, a default, or both. Interest payments on that debt alone are now eating a bigger slice of the federal budget than defense spending. Think about that. We're paying more to service debt we've already racked up than we're paying to actually run the country. And every time the Treasury issues new bonds to cover the gap, it competes with itself for buyers, pushing yields higher, which makes the next round of debt even more expensive to service. It's a spiral, not a metaphorical one, a literal, compounding, mathematical spiral. And here's the part that makes it worse. This isn't happening in isolation. Entitlement obligations keep growing as the population ages, defense spending isn't shrinking given the current geopolitical climate, and there's no political appetite in either party for the kind of spending cuts or tax increases that would actually close the gap. So the debt doesn't level off. It compounds on top of itself, year after year, budget after budget. Every dollar of new borrowing today becomes tomorrow's higher interest bill, which forces even more borrowing just to stand still. That's the mechanical trap hiding underneath all the political noise. And it's worth remembering this isn't a new warning either. Economists have been flagging the trajectory of this debt load for over a decade. What's different now is the math has actually caught up with the warnings. The interest bill is no longer a rounding error buried in a budget footnote. It's now one of the single largest line items the government pays for every year, competing directly with defense, healthcare, and infrastructure for the same shrinking pool of revenue. That's why calling this a temporary rough patch misses the point entirely. This isn't a cycle the Fed can wait out. It's structural, and structural problems don't get solved by a couple of rate decisions. So why can't the Fed just fix it? Raise rates, crush inflation, done, right? Here's the trap. If the Fed raises rates aggressively enough to actually kill inflation, it blows up the interest expense on that same mountain of federal debt, along with everything in the banking and housing sector that's built on cheap money. We already got a preview of that fragility with the regional bank stress a couple years back, when rate hikes alone were enough to put multiple banks underwater on their bond portfolios almost overnight. But if the Fed keeps rates low or starts cutting to protect the system, it lets inflation run hot, which erodes the currency anyway and punishes anyone holding cash or fixed income assets. Raise rates, break the debt machine. Cut rates, break the currency. There is no clean third door. That's not a policy failure. That's a mathematical box the Fed built for itself over 2 decades of easy money, quantitative easing, and near-zero interest rate policy that made debt look free for far too long. Every tool in the Fed's playbook was designed for a world where debt was manageable. That world doesn't exist anymore, and the toolkit hasn't caught up. And this isn't just a domestic problem either. Foreign holders of U.S. debt are watching the same math everyone else is, and every incremental step away from treasuries by a major foreign buyer makes the next auction a little harder, which pushes yields up further and tightens the trap another notch. The Fed can influence short-term rates directly, but longer-term yields are increasingly being set by a market that's starting to price in exactly the dilemma we're describing here. That's what permanently trapped actually means. Every path the Fed takes from here debases something. The only open question is what gets debased first, and how fast. Now here's where it stops being an abstract policy problem and starts being your problem. When a central bank is trapped like this, the historical playbook is depressingly consistent. Print, devalue, repeat. We've watched it happen in Argentina, in Turkey, in Weimar Germany, in the most extreme case. The mechanism is always the same. The currency's purchasing power gets quietly sacrificed to keep the government solvent. And the dollar isn't immune just because it's the world's reserve currency. In fact, that status is exactly what's now being tested. Central banks around the world have been net buyers of gold for years running, at a pace we haven't seen in decades, actively diversifying away from dollar-denominated reserves. That's not coincidence. That's central bankers hedging their own reserves against the same trap I just described, in real time, with real money, while still saying all the right things about the dollar in public. Watch what they do with their own balance sheets, not what they say in press conferences. Actions there are years ahead of the headlines everyone else is reacting to. This shift has been building quietly for years, well before it started showing up in mainstream financial coverage, and it tends to accelerate once other institutions notice the pattern and don't want to be the last ones holding an asset everyone else is already stepping away from. Reserve status isn't lost overnight. It erodes gradually, through exactly this kind of slow accumulation of small decisions by large institutions, until one day the shift looks obvious in hindsight, even though it was visible the entire time to anyone paying attention. When the people who run the system start quietly de-risking away from their own currency, that's not a signal to ignore. That's the signal. So where does that leave gold and silver in all of this? Gold isn't a trade. It's not a ticker you flip in and out of. For over 5,000 years across every currency collapse, every war, every empire that overextended itself, physical gold has done exactly one job: hold value when paper promises stopped meaning anything. Silver does something similar, but with more volatility and more upside torque, because it's both a monetary metal and an industrial one. Demand from solar panels, electronics, and EVs stacks on top of the same debasement hedge, creating a supply-demand squeeze that gold alone doesn't have. That's why when gold holds a key support level under macro pressure like this, it matters. It's telling you the floor under the debasement trade hasn't cracked, even as the dollar's long-term story keeps deteriorating. Support levels like this are where smart accumulation typically happens, quietly, before the next leg up gets the headlines. Silver in particular tends to lag gold early in these cycles, then catch up fast once the broader public finally notices what's happening, which is exactly why the quiet accumulation phase matters more than the headline phase. Mining supply for both metals has also struggled to keep pace with demand, since new discoveries have gotten smaller and permitting new mines takes years in most jurisdictions, which means the supply side of this equation isn't going to solve itself quickly, even if demand stayed flat, and demand is doing the opposite of staying flat right now. This is precisely why serious money, central banks, sovereign wealth funds, long-horizon investors treats metals as insurance, not speculation. Insurance you buy before the fire, not after. Here's the mistake most people make with this information. They hear all of this and do nothing. They wait for confirmation. They wait for the headline that says, "Currency crisis official." But by the time that headline exists, the metals have already repriced, and you're buying the top of a panic instead of the bottom of a trend. The families who come out ahead of currency debasement events historically are the ones who moved early and boringly. A steady allocation into physical gold and silver, held directly, not chased in a moment of fear. Not leverage, not speculation, just tangible ownership of something the Fed can't print more of, and something that doesn't carry counterparty risk the way a paper promise does. It's not exciting. It won't make for a dramatic headline of its own, but boring is exactly what survives a currency crisis, while exciting is usually what gets wiped out by one. That's the entire strategy. Boring, early, and tangible beats panicked. Late, and paper every single time. So here's the verdict. The debt spiral is real. The Fed's trap is real, and it's not closing anytime soon. And gold holding its support level right now isn't noise. It's confirmation that the flight to hard assets has real conviction behind it. My take, this is a strong buy signal for accumulating physical precious metals, not for a trade, but for long-term wealth preservation while this plays out over the next several years. The people who understand this early aren't gambling. They're just paying attention before everyone else has to. If you found this breakdown useful, hit subscribe, because I cover moves like this, debt, the dollar, and hard assets, every single week, and you don't want to be catching up after the next headline instead of before it. Drop a comment with where you think gold heads next. I read everyone. And if you want the deeper dive on how to actually structure a physical metals allocation without overpaying premiums, check the video linked right here on your screen. I'm Kenji Sinclair. I'll see you in the next one.